Hello, welcome back. Let's take a look at Roblox. The company reported earnings and didn't go well because that didn't really go well because it's actually down 16% after hours. So we're expecting them when the market opens up to see this kind of decline in the stock price. So you'll notice that the company used to have a price of about 140 and you would have been really burnt if you bought around these levels. Because right now it will be sitting at about 61 or $62, and so that's more than like a 60% decline. It's a massive decline if you bought at all-time highs. Regardless, yeah, the company did miss some estimates, some analyst estimates, and the market decided that it should go down, of course. And regardless of that, we want to examine what the company is doing financially, see whether it's a potential hold for us from now on, whether it's actually worthwhile to buy, because there's always a price for most companies really. Now, in this video, I'm gonna be using and utilizing a discounted cash flow model at the very end, with which we're gonna derive a value that we want to be paying for the stock today, if we were to buy it today, just to see whether it's overvalued or undervalued, trying to spot what the intrinsic value of the stock is based on its free cash flow. So let's start by taking a look at the outstanding shares here. You will see that they are growing a little bit, but not massively, so the company did issue some shares. But this is just months, it's not even a year, so you could see them issuing more, and that's obviously not great. Although with the stock price decreasing, maybe they're gonna put this off for a while. Now let's take a closer look at the earnings report next to examine the financials of the company and how they are doing with their operations. And I meant the income statement really. So the income statement here, you will see that the year-over-year growth of the company seems to be accelerating, which is nice to see. But the bad thing that I noticed here is that their net income is, it's actually in the negative. And it's actually increasingly in the negative. So that's not a great sign. But let's take a look at the balance sheet of the company. Two important things here that I want to always be looking at. It's the total liabilities, which are sitting at 2.6 billion right now, and the total equity, which is sitting at 600 million. So we have many more liabilities than what we have equity. And that's not a great sign, of course. A company has more debt than equity, really, at this point. Cash flow of the company. Notice that we have decreasing net income here, but you will see that the cash from operations from operating activities is positive, and that's because of change in unearned revenues. This is basically money that suppliers or customers, really clients of Roblox paid in upfront, yet Roblox hasn't really delivered the service or product. And this is money coming in, so it's actually money paid already, and this is why it shows up here in cash from operations. So cash from investing, you will see that the company is investing a little bit just in some acquisitions and capital expenditures for the most part, and not much activity really. But the cash from financing company has 602 million here. For some reason we don't have the details, but this is some debt that the company got. It's a issuance of common stock plus some debt, which for some reason is not accounted for here in these numbers in the software. And the free cash flow from 35 million to 615 million over here. And again, we're going to use this free cash flow to make an estimate very, very shortly. But let's also take a look at the multiples of the company, which are sitting very, very high, the ones that we have over here. 25 to 24, 25 is super high. You want like 3 or something. And the profitability of the company, again, in the negative, as expected pretty much. And solvency, the total liabilities to total assets is high, of course. Probably not at the point that it's going to break down the company right now, but it's not looking that pretty right now. Now, the next thing that I want to do in order to determine whether it's worthwhile taking a look at this company and actually potentially owning it is I want to see, based on the free cash flow that the company is making, can I actually buy the company at what cost, at what price? And this is where I have created a discounted cash flow model, which you can see here. And I have added over here, as you can see, the free cash flow in millions. And these are these values over here, 35.5, 15.9. You will actually see these values here. added for year 1 to year 5. Now, year 1 is not non-existent here because we have 4 years of data. This is a new IPO, and because of that, I have added sort of like a placeholder value. Don't pay attention to that. The reason why I added it is so that we get this calculation over here, which gives us the 5-year average free cash flow growth based on these 4 values. And of course, you will notice that there has been a massive increase here, and this is really affecting the free cash flow growth. And we need to use a free cash flow growth for our model, and so we're using these calculations as a baseline, but the thing is they are all over the place. So what do we want to be using here? I think I'm just gonna go conservative with this one, not too conservative, but still relatively conservative. Based on what I've been seeing, I mean, the last couple of years, things look to be getting a little bit better. So I think I'm gonna go with a free cash flow growth of 15% here for these calculations. Now, you can obviously try different scenarios and try all sorts of potential free cash flow growths, but I think a 15% is conservative enough, and probably the company will be growing a little bit more as long as their operations continue at the same pace or better. And I'm going to give it a discount rate of 13%, which is basically saying that I want to be making 13% of my money back every year annually if I am to buy this stock. And a perpetual growth rate of 1% is what I like to give here, which is the long-term growth rate of the company. Cannot really be more than 1 to 2%, because if that happens, it actually surpasses the economy in terms of growth, and so that cannot really happen at any point for any company. And so this model right now, we have given all the values that it needs, and I also gave it the outstanding shares in million over here. And now it has all the data to calculate what's the price per share to pay today based again on these assumptions. And so the price to pay today would be $22 based again on these assumptions. And the model automatically calculates free cash flow with a 15% gain increase every year, and adjusts these values to present values for today, and also generates a terminal value and the total value of the company at almost 13 billion for the next decade, and then on, and plus a terminal value. And this gives us a price to pay today of about 22.4, as I said. And if we thought that the company could grow a little bit more, because that really affects the calculations here. Let's say it grows 20%, and we're okay with that. Now we are willing to pay $31.36 for the company if we accept that the free cash flow of the company is going to grow at 20%, and let's say that we want to be getting 12 instead of 13% a year in terms of our gains. Now we are willing to pay $35.32 for the company. The problem is that the company is going to be sitting at $61 almost when it opens up, and so it's still expensive for my taste, and especially due to the fact that it's still a new company and we don't know what's going to happen. I don't want to commit money to a company that would probably make sense for me to buy probably at this level, to tell you the truth, maybe about 25 to 27, maybe a little bit more. I think at this range I would be happy to buy the company. Yeah, like 20 to 25 really would be my okay price for the company. And even if we give it a 2% here, which is excessive potentially, we're still getting 26%. This doesn't really affect it that much. So hopefully that gives you a baseline and gives you some ideas of how to think about the company. And let me tell you, you tell me, not let me tell you, don't let me tell you, you tell me, do you own the company? And are you thinking of potentially buying it? What do you think about it? Let me know in the comments below. And if you haven't subscribed to the channel, please do. And leave a like if you enjoyed the video. That really helps the channel grow and helps me a lot to make more videos for you. I'd love to see you on our Discord channel as well. You can find a link in the description box below. And if you did like this video and you enjoy watching this type of analysis, take a look at this one that I made earlier, and it's about Meta or Facebook, in which we're discussing the recent drop and whether it's a potentially interesting buy right now. Thank you for watching. See you soon. Bye-bye.